Good morning, everyone. Thank you for joining us for this webinar this morning. Before we get started, for those that don't know me, my name is Jeremy O'Neill. I'm a senior manager within the GST team here at Grant Thornton. I do have a stammer, so please bear with me if I do get stuck and I do stammer. Today, I'm also joined by a special guest. We have Sue Howe on the webinar this morning, who acts as a GST senior advisor on a number of larger projects and assignments with Grant Thornton. Thanks for taking the time for joining us today, Sue Howe. We are happy to facilitate questions, so please feel free to insert any questions that you do have within the Q&A section at the top or the bottom of your screen. And the last point is we will be sharing a copy of the slides and the recording once the webinar has finished. With that, before we jump into the detail, I just want to give a quick overview of the content that we'll be covering on the webinar today. In short, we'll be explaining what missing trader fraud is, how it may impact your business, and what you need to do to mitigate the risks that it poses to your business. With that in mind, I'll hand over to Sue Howe to take us through the first part of the webinar today.
Thanks, Jeremy. Good morning, everybody. So good to see so many of you participating in this morning's webinar. I hope my earbuds are working well in terms of volume. But as I say, it's so good to see a few familiar names as well. I'm still waiting for that invitation to coffee from some of you. So hope I'll catch up with you guys after we have these restrictions lifted. So let's start off with talking about what is missing trader fraud. If I may, next slide, Jeremy. Yeah. Okay. So missing trader fraud actually started in the European Union, where the VAT rates are actually higher. And according to a 2018 study by the European Commission, missing trader fraud was basically the largest or the most damaging, as well as the most damaging type of cross-border fraud in Europe, resulting in an estimated loss of about $60 billion on an annual basis. What is also concerning is that actually it was also found that organized crime groups were also behind 80% of the fraud. And that fraud actually has found its way to this part of the world, to Asian countries like China, Japan, and Cambodia, and even now in Singapore. So according to the second Minister for Finance, or now our Finance Minister, Lawrence Wong, in a parliamentary response in November 2020, when the GST Amendment Bill was in the second reading, he said that the number of businesses that the IRAS was currently investigating for suspicion of missing trader fraud was more than 300 cases. All right, so IRAS has about 300 over cases with $450 million at stake. This was at the end of 2019. Now, Finance Minister also confirmed that the IRS has actually completed something like 70, has completed the investigations of 70 businesses, and the amount of GST involved was something like $90 million. Now, to put that in context, $90 million in additional tax from 70 businesses means that each business actually went through adjustments of something like $17 million, which means an average of $1.2 million of GST involved. So as you can see, the number is quite staggering when you look at how much GST is involved when it comes to a missing trader fraud. Of course, out of the 300 businesses that is under investigation, it's interesting to know how many of those traders or how many of those businesses were actually missing traders, or they were just businesses that found themselves caught up in a missing trader fraud arrangement. So let's talk about what is the missing trader fraud and then how it works. Next slide. So if you look at the missing trader fraud, it always starts off with a company A, in this case, right, importing goods into Singapore. So in the example we have business A importing goods and selling the goods for $1 million to his customer B. So in business A, company A, being GST registered, what they do is that they will charge and collect 70,000 in GST from his customer B. And what happens here? Company A or business A is just becomes a missing trader. He actually disappears without accounting the GST amount of 70,000 to the IRAS. Now, as far as company B is concerned, company B now has an input tax credit of $70,000. And then in this case, $1 million worth of goods that he has bought, he now sells it to company C at 1.5 million, of which he collects $150,000 in GST. So on a net basis, he will account $35,000 to the IRS, being the 105,000 output tax less credit of 70,000, right? So as far as the IRAS is concerned, they receive 35,000. And when it comes to company C will now have an input tax credit of 105,000. Sorry, he would have an input tax. Yeah, he will have an input tax credit of 105,000, of which he had paid over to company B. But in this case, company C actually exports the goods to company D, an overseas customer, of which he is able to zero rate those transactions. That's assuming he's got all the export documents. So what happens here as far as company C is concerned? On the output tax, he has zero, but on the input tax, he has 105,000, of which he will get a refund of 105,000. And then when the goods go over to company D, typically what will happen, the same goods can come back into Singapore. And you can look at this supply chain, right? It is what we refer to as a carousel fraud. And then the company A can reappear as a new company. And sometimes in the UK and Europe, as you call it, the Phoenix syndrome as well. So when you look at this supply chain, now typically, as I said, the more companies you have in the supply chain, the harder it is for the IRS to detect fraud in this kind of arrangement. And in most cases, missing trader fraud actually involves more than just A, B, and C. As I say, typically you will have more companies in this supply chain. And this, by its nature, is how a missing trader fraud arises. And as I said, it is sometimes referred to as a carousel fraud. Next slide. So how has the IRAS been addressing this? Well, we had actually two legislative responses so far. On the 1st of January 2019, the government actually introduced what we call customer accounting. All right, now what customer accounting is, it actually operates like a domestic reverse charge on prescribed goods. And the type of goods that are subject to customer accounting are mobile phones, memory cards, and off-the-shelf software. Basically, these are high volume, low margin goods. But effectively, what it requires the customer to do is to account for the GST as if he were the supplier, but at the same time, he claims a credit for the input tax. So instead of having the supplier account for the output tax, and then with the concern that the supplier may disappear, under customer accounting rules, it is the customer who accounts for the output tax as well as claim credit for the input tax. Now, as you can see, now such rules obviously have its limitations, because what happens is that if you have to define the type of goods that are subject to the customer accounting rules, the law will always be playing catch up, right? Because at the moment it's restricted to mobile phone, memory cards, and off-the-shelf software. But what happens if the IRS keeps finding different types of goods, right, that may be subject to missing trader fraud? So as I said, the law has its limitations because it will always be playing catch up. So as an example, the UK Customs actually in March of this year included building and construction services as to be part of this customer accounting. So these rules that we have here in Singapore actually is something that we adopted from the UK. Now, knowing the limitations, what the government has since done is they introduced the GST Amendment Act, and it comes into effect from the 1st of January 2021. And under the GST Amendment Act, what the thrust of the legislation is to deny the input tax claims if a business knew or should have known that the transactions that it's involved in are connected with a missing trader fraud arrangement. So let me just introduce you some of the, let me just highlight some of the key provisions on the next slide. So under the GST Amendment Act 2020, which as I said came into effect from the 1st of January 2021, the controller of GST can actually withhold or deny input tax claims if the business knew or should have known that the purchasers were part or connected with the missing trader fraud. Now, this is what referred to as the knowledge principle. Now, on top of that, there's a 10% surcharge on the input tax that is so denied if the business should have known that the transactions were part of a missing trader fraud arrangement. Now, included in the Amendment Act were new provisions which allow the controller to refuse to cancel a GST registration or impose or vary any condition or on any registration. Now, the limitation in the previous law was that as soon as you hit $1 million in turnover, the controller has no option but to register you. But under the new rules, under the Amendment Act, the controller can actually refuse your GST registration even though your annual taxable turnover exceeds $1 million. And on top of that, of course, the controller has now enhanced powers, seizure of goods, right, to be able to, that are subject or that are suspected to be part of a missing trader fraud. I mean, the key provision in this denial of input tax is really the statement here that a taxable person is not entitled to credit any input tax or any supply made to the taxable person if the taxable person knew or should have known that it was part of an arrangement to cause loss of public revenue. What's important, please note the words in bracket, whether or not the loss was in fact caused. So regardless of whether there's any loss of public revenue, if a taxable person knew or should have known that the transaction is part of a missing trader fraud, the controller of GST can actually deny the input tax. So if you look at the next slide, if I may, these are the current rules in terms of claiming input tax. Now, the first 6 rules, I think, are conditions that we're familiar with. You've got to be GST registered, you must be in goods and services that must be supplied to you, etc., etc. It's actually condition 7. It is something we should pay attention to because in order for you to claim input tax, there is an additional condition that you must have taken reasonable steps to ascertain and concluded that the goods and services were not part of a missing trader fraud arrangement, and that conclusion is one that a reasonable person would have made. This is under the new section 22 capital A. So while you look at a missing trader fraud, while many of us in the audience may think that, well, this should only apply to companies that are part of a missing trader fraud, and my company is not part of a missing trader fraud. Now, that may be true to a large extent, but if you look at the conditions of input tax now, condition 7, right, now applies to all GST registered businesses. So if you think about it, if the IRS now sends you a letter and says that we're reviewing your input tax claims, please let us know. Please confirm that you satisfy all the conditions. Now, by and large, I think most of us will be, in fact, all of us will be able to say that we comply or we satisfy conditions 1 to 6. It is now condition 7, which is becoming a bit of a problem for all GST registered businesses. Now, with that as a matter of background, the IRS introduced an e-tax guide in February 2021, and this is where I'll hand the presentation over to Jeremy, who sort of explain to you what the IRS views are with regard to the missing trader fraud and what's covered by the IRS e-tax. Over to you, Jeremy.
Thank you very much, Suhal. Yep, as Suhal mentioned, the IRS have published their e-tax guide in relation to missing trader fraud, and it sort of covers their understanding and interpretation of the missing trader fraud legislation and is trying to provide a bit more clarity to taxpayers on how they're going to implement and to administer the rules in practice. I think the key point to start with is there are a couple of definitions within the guide, as Suhao just detailed. There's the knowledge principle, which is where a taxable person needs to determine whether they knew or should have known that the transaction was part of a missing trader fraud arrangement. We then have the missing trader, which back in the scenario at the beginning that Suhao mentioned is referring to company A. There's also a definition of what is referred to as a buffer company, which Suhao mentioned that during some of the more longer supply chains, you will notice that there's various companies between the missing trader and the exporter of the goods, which in our scenario was company C. And then, of course, we also have the exporter of the goods. Without the exporter of the goods, the missing trader fraud would ultimately not work. So that's also a key part of the supply chain there. And then just going into a bit more detail in respect of each of these. So as Suhao mentioned, the knowledge principle is ultimately where the taxpayer should have known that the purchase was part of a missing trader transaction. The crux of the principle is effectively to seek to determine whether you should have known or whether you knew that the transaction was part of a missing or was part of a fraudulent arrangement in the first place. In simple terms, what it's doing is shifting the accountability onto you, the taxpayer, to determine the validity of any transaction that you enter into. And on the next slide, we'll go into how the IRAS expect you to do that in practice. The knowledge principle is formed of 3 pillars, and we'll touch on each of the 3 pillars in a bit more detail in the next slides. The first pillar is ultimately where the business should conduct a risk assessment before it enters into any new transactions or new business arrangements. Once you've conducted the preliminary risk assessment, you should then perform your actual due diligence checks. So I'm sure that many of you will already have new customer and new supplier due diligence processes. However, these may not be sufficient within the eyes of the IRAS for the missing trader fraud arrangements. And then lastly, it's a case to make sure that you have documented the due diligence checks and the responses to the due diligence checks that you have performed. So with that in mind, we'll just touch on each of those pillars in a little bit more detail. As I mentioned, the first step is to conduct your initial risk assessment and focuses on the circumstances of the transaction to assess whether they are a type of transaction that's in your normal course of business. So for example, if the transaction represents a guaranteed profit, or you're receiving and delivering the goods on the same day, or if the payment terms are not really akin to your usual commercial arrangements, then it's beginning to raise a few flags. So simply speaking, the first pillar is to effectively use the sniff test to determine whether the motto, the transaction is too good to be true, should apply to this specific transaction. And once you've done the initial risk assessment, the next step is actually to perform the physical due diligence checks to confirm or to deny that the risks that were identified within the first pillar can be mitigated, or whether they still stand and that the company should potentially not proceed with the transaction. So the sort of checks that the IRS may expect you to conduct would be sort of credit searches, your due diligence in relation to the supplier's company status, that to validate the company's website, their trading address, just to ascertain whether the information they've provided is actually genuine in the first place. And then the last step is ultimately to wrap up step number 1 and step number 2, and it's effectively to document the outcome of your risk assessment and then the due diligence checks to confirm whether you should proceed with the transaction, or to clarify whether the red flags are still there and it's probably best not to proceed with the transaction. And what we've seen is that it may be beneficial to maintain a risk register to document the outcome of each of these onboarding processes that you have completed. So with that, we're just going to go through a quick application of how you would apply these 3 pillars in practice. So within this scenario here, we're company B and we are an experienced trader of electronic goods. And we're approached by a company A with an opportunity that they want to introduce us to company C. The reason why company A has come to us is because they've said that they don't have sufficient resources to handle the deliveries that company C and company D are looking for. When providing us the details in relation to the transaction, they've said that all we have to do is to receive the goods and fulfill the goods on the same day. We have a predefined profit margin, and also we don't have to pay for the goods until we have been paid by company C for the goods. So taking a step back, looking at those facts, I think most of you will realize that there are a couple of red flags in relation to whether they are genuine commercial practices, such as the minimal amount of resources required, and also the questionable payment terms. It's not often that company A, the supplier, will let you defer payment until you've been paid by your customers. So once you've identified those preliminary flags, the next step is actually to do our physical due diligence checks to see if we can get comfortable that the flags that we've identified are not because it's part of a suspicious transaction, but that it is a bona fide genuine transaction. And as we can see, the due diligence checks that we perform show that company has got a poor credit history. It's also in the business of dealing with beauty products, so it's looking to sell us a different product than what it would ordinarily trade in as part of its business. And there are certainly a lot of grey areas and lack of information as to both the source of the goods and the downstream supply chain. In other words, he's not really provided any information in relation to the exporter that we're expecting to sell the goods to. So I guess the ultimate question is, should we be proceeding with this transaction? I think most of you will agree that the red flags that we identified in pillar 1 haven't yet been satisfied by conducting the due diligence checks. In fact, the conducting of the due diligence checks probably raises more red flags than addressing the ones that were highlighted earlier on. So in this case, it would be prudent to obviously not proceed with the transaction because it is suspicious from that perspective. But it's still important to maintain the decision and to document the reasons for why you've made that decision within your company records. The key reason for this is that it evidences that you have conducted that process, you have conducted your due diligence checks, and ultimately that can be used has evidence should you ever become subject to an IRAS audit in respect of future subsequent transactions. It effectively provides IRAS that you have got that additional control in place, and therefore it will ensure that you meet the 7th condition for claiming the input tax in respect of your the transactions that are not party to a missing trader fraud arrangement. With that in mind, the IRAC guide also covers sort of the expectation from a record keeping perspective. And whilst conducting the due diligence checks is obviously of paramount importance, it's equally important to retain and maintain the documents of the checks that you have conducted, because this is ultimately going to be your first line of defense should you become subject to an IRAS audit. As mentioned earlier, for many of you, it's probably a case of expanding your current onboarding process to cover the additional requirements that the IRAS have now implemented for the input tax recovery methods. But for some companies, it will be a case of you'll need to implement a new formal onboarding process, which can include a risk register and the approval of a new business relation check process. And sort of moving on, so let's say you were subject to an IRAS audit in respect of a missing trader fraud. You were caught up within one of these transactions. In terms of the appeals process and the audit process, the first step will be that the IRAS will notify you that your input tax claims are coming under their review on the grounds of missing trader fraud and the knowledge principle. And there'll be a situation where they will come in, they will discuss with the company what processes you have around your due diligence checks, around ensuring that you are testing for the knowledge principle in the first place. And then upon their investigation, they will issue you a notice, obviously, and that will say that either they are withholding your GST input claims, or that they are satisfied that the steps you took were reasonable, and on that basis that you should be entitled to claim your GST. So whilst there is various wording around, the IRAS would not expect you to go beyond what is reasonable, there's obviously some ambiguity around what is considered reasonable, because that is ultimately going to depend on the complexity of the business and the transaction that is being undertaken at the time. However, if you do get caught up in such a transaction and the IRS conclude that your GST claims should be withheld, there is an appeals process. The first step is that you would appeal to the controller of GST within 30 days of the decision. The appeal, you'll need to provide the grounds for which you disagree with the decision that's been made, and then the controller will review your appeal, and subject to the findings, if they conclude that the IRS were correct to withhold your GST claims, then you can also appeal to the GST Board of Review. Again, that appeal will need to be submitted within 30 days, and you'll need to detail the grounds for which you believe the decision has been incorrect to date. And then the case will be heard by the GST Board of Review, and then they will issue their decision in respect of your case. So with that in mind, having detailed what missing trader fraud is, having detailed the additional legislation that's been implemented and the IRS tax guide to provide a bit more colour to the legislation. The next step is, what can you do to mitigate the risks that are posed by missing trader fraud transactions and the new knowledge principle for your GST claims? So we've helped a number of clients over the last few months to implement additional controls to mitigate the risks and the challenges that this poses. And with most cases, it's been a case of using a mixture of techniques, because as I'm sure you can all appreciate, it's not a case of there's a one size fits all. Some of the solutions will be more suitable to your businesses than others, and also in respect of the circumstances in which you may be conducting these transactions. With that, I'll hand back over to Suhal to provide his insights and his experience on the area of risk mitigation and what businesses should be doing to defend themselves.
All right, thanks very much, Jeremy. So essentially, I'm going to just talk about some observations on the e-tax guide, but I'll start off with just summarizing the knowledge principle. So under the knowledge principle, what the IRS is saying that your input tax claims will not be denied if you took reasonable steps to ascertain that the supply was not part of the arrangement that causes loss of public revenue, and you concluded that the supply was indeed not subject to a missing trader fraud. And the conclusion is one that a reasonable person would have made. So the lesson here, or the message, comes out very strongly from the IRS e-tax guide, is that if you ignore the warning signs and you fail to exercise the due diligence or make reasonable judgments on the transactions, then you will risk losing your input tax claims under the knowledge principle. So, having sort of summarized the knowledge principle, let me just share or make some observations regarding the IRS e-tax guide and what the new rules mean. Now, as I said, the new rules say that you risk losing your input tax claims if the business knew or should have known. Now, if the business knew that it was part of a missing trader fraud arrangement, there are already existing anti-avoidance provisions under Section 62 and 63 of the GST Act, where the IRS can come in and then obviously throw you in jail, right? But when you look at the test of should have known, right? Now, it is usually with the benefit of hindsight, right? And it is very rare, from my experience, it is very rare that you will get direct evidence that the taxpayer should have known that he was involved in a fraudulent transaction. So this test of should have known certainly is very onerous. It's something that was adapted from the UK legislation, but there is a certain protection offered by the UK legislation, because as far as the UK authorities' approach is that they make it very clear that the burden of proof is actually on HM, Her Majesty's Revenue and Customs. In fact, in their VAT fraud manual, they say that the burden of proof lies with HMRC to show that on the balance of probabilities, the taxable person knew or should have known that he was involved in VAT fraud, or that his transactions were involved in fraudulent evasion of VAT. Now, actually, Second Minister, or now Finance Minister Lawrence Wong, actually gave that assurance in Parliament. He actually said that the burden of proof is with the IRAS. However, if you look at the e-tax guide, there is no such statement made in the e-tax guide. What the e-tax guide says is that if you don't like the denial of input tax claims, what will happen is that we'll sue you in court, meaning that you got to take the case to the GST Board of Review, and that is at the Board of Review stage. That's when the burden of proof actually shifts to the IRAS. So that's what I'm saying, that while we have that assurance by the finance minister, right, that the burden of proof is actually lies with the IRS. Don't quite see that statement in the e-tax guide. But what the IRS have said instead is that the burden of proof will shift to the IRS only if you take the matter to the GST Board of Review. My question then is that how many taxpayers are willing to take that matter to the Board of Review? But having said that, though, if you've got $1.2 million worth of your input tax claims at stake, then it may be worth engaging the advisor or the lawyers to help you take the matter to court, right? The other question I have is that the other observation that I have is that the missing trader fraud checks, right, that the IRS now expects of you that are outlined in described in the e-tax guide. Are we expecting them to be part of an ACAT review or an ASK review? We actually asked the question of the IRS, but the IRS was they sort of didn't answer the question. Now, my view is that it will probably end up being part of your ASK or ACAT reviews now, which makes it very difficult for a reviewer, right, trying to determine as to whether your checks are adequate. Because I don't think I've got the skill set to be able to say that. I can only rely on what's in the e-tax guide. But the question that even if I follow what the e-tax guide says, in terms of saying that the client has done all the following, the question is how much is enough? And there's a lot of discretion, I think, in the hands of the IRS to decide whether your due diligence checks are adequate enough to satisfy the controller that you reach a reasonable conclusion that your transactions are not part of a missing trader fraud. So I think that's where I think it's just something we need to be mindful of. Now, the other thing too, a lot of the examples that we spoke about earlier on, it's all in relation to goods. But when you look at the legislation itself, and even the IRS e-tax guide, the IRS says the MTF arrangement, the missing trader fraud arrangement, can equally apply, or the missing trader fraud rules can equally apply to services. But when it comes to goods, it's easier to sort of check authenticity, whether these are high quality goods worth the price that the traders say they are. They are, but when it comes to services, I think it's a bit challenging. We also asked the IRS the question as to, look, have there been any missing trader fraud that involves services? Again, they didn't quite answer the question. Um, and I was struggling to try to figure out what sort of services could be subject to missing trader fraud. Because when it comes to services, it's a lot harder. Having said that, though, the UK had issues around carbon credits, and that was obviously one area where carbon credits were subject to missing trader fraud arrangements. As I said earlier on as well, right, building and construction services are part of the domestic reverse charge in the UK, which again could be another area whereby missing trader fraud uh, could could cover as far where building and construction services could be one area where the missing trader fraud could actually cover as well. So again, as I said, if you're talking about goods, it's easy to look at it. If something is tangible, but when it comes to services, I think it's a bit more tricky. But as far as I'm aware, there haven't been any services that have been subject to missing trader fraud in Singapore. A lot of cases that I've been dealing with involves a lot of goods in mobile phones, etc. But that doesn't mean that we will not see services being subject to missing trader fraud arrangements. Now, as far as risk mitigation, so going back to this slide in terms of risk mitigation, what should you do now? Obviously, there's an expectation that you should integrate missing trader fraud risk management in the governance framework. Uh, and by and large, as I said, if you are in a business that has been subject to an ACAT review, tax governance or GST governance framework is quite critical. But the current framework that you currently have are probably not adequate or not sufficient enough to cover missing trader fraud arrangements. Now you have to conduct and document your risk assessment because, as I said, that's part of the expectation because record keeping it's an area where the IRAS takes a lot of emphasis on, as you and I know. And that means if you have to say to the IRS that you do and you've done your due diligence checks, there's an expectation that they will ask you for those records in terms of your documented findings on the risks that you have identified. and your responses to those risks. Awareness and training is another area that I think is something that you need to be talking to your staff on in terms of these new legislative changes. But don't just involve tax and finance, because when you look at missing trader fraud, it goes beyond tax and finance, right? It goes to the people who's involved in business development. It goes to the procurement people. And when it comes to business development, obviously your colleagues are very keen to bring in new business for the company, but are they aware that there's this new rule as far as GST is concerned, whereby adequate due diligence checks need to be conducted and performed when you onboard your new supplier. And that goes to the point about reviewing your current supplier and customer onboarding process. I'm sure they are quite robust at the moment. The question is whether are they robust enough to include those due diligence checks to address missing trader fraud risk. Now, the other thing too, the IRS have said that you should be doing is that you should be wary of transactions which are too good to be true, which means these are referring to transactions which are outside the way you normally carry out your business. Yeah. Just as we are told that whenever you get a call from an unknown number, if the deal is too good to be true, it is probably a scam. Well, that's the same expectation that the IRS have of you when it comes to your business transactions. I mentioned the regular training and the refreshers because obviously this is new to a lot of businesses, but it's something that we need to be aware of. Yeah. And of course, conducting the periodic GST reviews and all of that, the focuses on your returns, your systems, and your processes, and your technical positions on risky areas is something that you should be doing in any case. Yeah? Okay, with that, let's move to some concluding remarks and some key takeaways. Now, the new legislation and the new missing trader fraud rules, obviously to address the risks, have wide and quite profound impact. Now, in the COVID-19 environment that we have, we are obviously seeing falling tax revenues, right? And of course, we have also had to spend a lot insofar as the measures to help businesses are concerned. Now, that means that highlights the need for the IRS to ensure that everybody is paying their fair share of taxes. Now, at the same time, COVID-19 has also increased the opportunity and the motivation for fraud. And that motivation obviously increases when the GST rate goes up. So quite clearly, we can expect the IRS to be quite vigilant. They have already started to target businesses and use the new measures. In fact, there are quite a number of cases that are now before the Board of Review where the IRS have applied the rules retrospectively. Because bearing in mind the rules only come in from the 1st of January 2021, but some of the cases that are now currently before the Board of Review, actually the IRS applying the rules as if they already existed prior to 1 January 2021. Okay, so for us, for all of us, now regardless of whether you believe that your company will or could be a potential target of missing trader fraud arrangement, the advice is you need to take stock, you need to improve your current processes for fraud detection. And that's something, an area that I don't think many people are prepared for, but that's certainly something that's expected to you under the new GST rules. At the end of the day, you got to ensure you're not caught in this carousel run. Okay. All right. With that basically sort of finishes what we wanted to say. So Jeremy and I are more than happy to take questions that you may have. So we'll just stay on because we have a bit more time. So over to the audience. You can either unmute yourself and ask the question, or you could use our Q&A box there, put in your question. Yeah.
Yep. So I've got a question I've received here.
Sure.
You mentioned that there have been that Lawrence Wong, who I think was the second Prime Minister at the time, in the second reading of the legislation, mentions that the burden of proof should be with the IRS and not with the taxpayer. However, you also mentioned that that typically would only happen once it gets to the stage of the GST Board of Review. At the beginning of the session, you mentioned that there have already been a number of cases which have been referred to the GST Board of Review. Have any of the decisions that the Board of Review made touched on the topic of where the burden of proof lies?
No, well, not so much addressing the burden of proof, but there has been one case. All right, as I said, there are quite a number of cases, but I'm aware of at least one case that has been finalized at the Board of Review. Uh, and guess what? In that situation, the Board of Review actually ruled in favor of the taxpayer. All right, because prior to the missing trader rules, prior to the GST Amendment Act, I certainly struggled to find a find a legislation whereby the IRS can simply deny input tax claim. Now,
Yep.
as I said, under the new Section 22A, which only comes into effect for the 1st of January 2021, sure, the IRS can say that, well, your situation, did you do your due diligence checks, etc., and you didn't, we're going to deny you the input tax claim. But that provision is new. It wasn't in place prior to 1 January 2021. So without knowing the actual judgment itself, because it's not been published as yet, but I'm aware that the Board of Review actually ruled in favor of the taxpayer. Um, the in that situation, as I said, the Board of Review actually said that the taxpayer was entitled to the input tax claims based on the conditions that they were GST registered, based on those 6 conditions that we have sort of outlined in the earlier slide. Now, obviously, the case is on appeal because there is quite a lot to lose as far as the IRS is concerned. But we do not know when it's going to happen. But that's the only case
Yeah.
that I'm aware of. But it did not address the question of whether there's a burden of proof.
Yeah. And there's another sort of more general question here. Has the IRS in any discussion sort of have they outlined how they actually identify missing trader fraud arrangements? How do they actually what sort of reviews or flags do they look from their perspective to identify potential transactions to then go out and conduct their investigations?
Other than third-party information, other than whistleblowing cases, blower cases, a lot of it has to do with the amount of input tax claims. Now, we all know that all refund claims to the IRS typically is subject to audit, right? It could
Yep.
be, and it's fairly routine in terms of what they do. But obviously, in a situation where the taxpayer suddenly claims large or has a significant refund claim, that is a bit out of the norm as far as that company is concerned, then that obviously triggers a bit of alarm bell at the IRS. And they would always start off by asking, can you let us know what's giving rise to refund claims? Give us a list of your taxable purchases. Give us your tax invoices. And I think that's how it all started with
Yep.
regard to the missing trader. But again, once they come across such an arrangement, typically in the supply chain, as I said, there are obviously quite a number of companies involved in what we refer to as the buffer companies, right? So if one of them investigated, I think a typical approach of the IRS will be to extend the audit to everyone in the
Yep.
supply chain.
Yep.
And that's probably what has happened. Yeah.
Okay.
Right. Yep.
And
Go on.
then there are two questions which I'm probably
Yes,
going
that's
to
right.
try and join together.
Go ahead.
Um, there's one question in terms of would you say there's a need to conduct due diligence checks on current suppliers, so those that were onboarded prior to the 1st of January 2021, the ones that you're doing regular transactions with? It'll be interesting to hear your.
Yep.
hear your views there as well.
Yeah, no, that's a good question. The question is, whether we have to do due diligence checks on all existing suppliers. I don't think there's an expectation that you need to do that. However, however, that is provided that the business you have with them are sort of fairly normal and they're on a sort of a fairly even keel. If there is any significant or any material change in your arrangements with them, right? For instance, they suddenly tell you that, look, can we deal everything? Can all our future transactions be dealt in cash? Or they suddenly selling you products that they don't normally deal with. Those are sort of the risks or the red flags that you spoke about earlier on, right?
Mm.
And those are the ones whereby the IRS would then expect you to do your due diligence check on those current suppliers. But at present, I don't certainly don't think you need to. I was actually participating in another webinar, and one of the speakers was a lawyer. The lawyer felt that you need to. I disagree. I actually think you don't have to do it on the current suppliers unless, as I said, there is a material change in the in your dealings with the existing vendor.
Yeah,
Okay.
he's probably coming from the perspective of a professional service firm where we, Grant Thornton, would still have to do our regular updates. So we would still do periodic reviews of our clients and our suppliers to make sure that, as a refresher, to update our due diligence checks
Sure,
on a periodic
sure,
basis. But yeah,
sure.
that's interesting. And then one of the last ones was what kind of services can we provide to help businesses comply with the new legislation and the new expectations. So I think I'll just slide back to the risk mitigation slide that we have that Suhal mentioned earlier. There are various ways in which a business can mitigate the risk and effectively have that evidence to show that they they did not know and their checks were reasonable to conclude that they should not have known that the transaction was subject to a missing trader fraud and therefore would effectively protect their GST input claims. As we mentioned, the first one is having a robust onboarding process. Whilst determining what is reasonable is obviously a challenge because it is often dependent on the nature of the transaction. It is important to have a formal process within your control framework, and we can help clients with the implementation and with the design of such processes. And again, one of the most important areas is actually making sure the relevant personnel are aware of the new legislation that came in. So part of being on this webinar is a good stepping stone to increase the awareness within your companies that these rules are in place and to begin putting steps in place to ensure that you have sufficient controls in process. However, we're obviously more than happy to provide more formal training. We can provide customized specialist training for your tax, your legal, your finance, and your sales teams to get them up to speed, to give them insights for how they can identify the risks in the first place, and then through to the documentation and the final the final assessment of whether you should proceed with the transaction. And then, of course, we can help with the periodic GST reviews. But as Suham mentioned, there's some ambiguity from the IRAS's perspective as to whether the review of the knowledge principle will squarely come under some of the IRAS's methodologies in respect of the ASK and the ACAPs. Suha, do you have anything else to
Yeah,
mention in relation to that point?
I think just a couple of points to add to that. I suspect if you ask the IRS today, they say, will this due diligence check be included as part of the ACAP and ASK review? I like the answer would be no. However, over time, I suspect it will creep into the review methodology. So it becomes a question that you need to ask yourself. Have you taken reasonable steps or the due diligence checks to identify MTF risk, mitigated fraud risk, and please show us your record. The other point I wanted to make, as far as awareness training is concerned, as I said, it's not a tax and function, it's not a tax and finance responsibility alone. A lot of this missing creator fraud actually involves, as Jeremy also mentioned earlier on, your procurement people, the people responsible for business development and all of that. So you need to involve your compliance officers. You need to involve the procurement teams. You need to involve them, your business people, and all of that, just to at least highlight to them what the potential risks are. Because as I say, the rules under the new rules don't just apply to the smaller companies where the control framework may not be very strong as yours, but nonetheless, as I say, but having said that though, when you look at the rules itself, it doesn't distinguish the types of organizations that have to follow these rules. In our feedback to the IRS, we actually say um, that look, perhaps you should exclude companies that have already been or undergone an ACAT review. It means you've been accredited with ACAT. Again, the IRS did not say yes to that. They say the rules are the rules, the laws are. So they're not going to make that distinction, although they say that, they obviously will take a pragmatic approach. But when you get a standard letter going out to all taxpayers and says, please confirm that you satisfy all these conditions, you're making input tax claims, regardless of the type and size of your organization, you still have to respond accordingly. Yeah, so that's what I wanted to say. There's a question here from Emily, but not sure if this has been covered, but the term of reasonable man is very broad. Could you elaborate more? Okay, so as far as what is reasonable, again, what you and I may consider reasonable may not be something that the IRS may agree with. So I think that's where the challenge is. Obviously, all the tests that we spoke about and what's outlined in the text are meant to be objective tests. But at the end of the day, you're still relying on an officer to decide whether the conclusion that you have reached, the reasonable conclusion that you have reached, is one that a reasonable person would have made, right? So it doesn't. I don't think it's sufficient for us to just. I mean, when I say we, I'm talking about you and I, to be able to say, oh, this is a reasonable conclusion. You may need a subject matter expert. You may need somebody, a risk person to be able to make that assessment. Obviously, if you get independent opinion, that certainly strengthens your position. But you on your own deciding that this is a reasonable conclusion may not be sufficient to satisfy the IRS officer, yeah, right? That those that conclusion you have reached is one that a reasonable man would have made, right? And the point here as well, when you look at those due diligence checks, you have to reach a conclusion. You cannot say I'm not able to reach a conclusion, because if you are unable to reach a conclusion, that is not adequate as far as the new requirements are concerned.
Mm.
Yeah, Jeremy, you going to say something?
So if I were to put my UK hat on, there are various references to what is reasonable of a reasonable person. And from a UK perspective, when we refer to, say, the customer's perspective or a reasonable person's perspective, what that is colloquially taken is to effectively mean a layman on the red bus. So it's, if you were to pick anyone up off the street, what is their view of the situation based on the facts put in front of them? But from what you've just mentioned there, it seems like the IRAS's interpretation is more, it should be a reasonable assessment made by a reasonable person. In other words, a reasonable person that has the ability to make and the knowledge to make that decision. Um, would that be fair to say? So it's actually, the IRAS have an additional expectation that you are assigning this, the decision-making process, to someone that has sufficient knowledge to be able to make the decision. Or have I kind of taken it a step too far?
Not necessarily. Certainly, if you ask the IRS will disagree with you and say, no, no, it's, whatever the innocent bystander uh, thinks is reasonable, that's good enough, that's strong enough a test for us. But we know how it works in reality, right? That in itself will not be sufficient. And if you're just going to get the person just sitting across from your desk and say, hey, do you think this is reasonable? And the person say yes, is that something the IRS would accept? Probably not, right? So if you are potentially caught in a situation like that, or you think you may be caught in a situation like that, as a matter of defense, if you ever had to appear before the review, I think it would help if you get somebody else to review it, and
Yeah.
not somebody, as I said, just innocently, innocent bystander. Now I know we're sort of skirting without answering the question directly, but actually there's guidance insofar as the IRAS e-tax guide is concerned. They just outline what are all the tests that you should be taking, but as I said, the key question is that how much is enough, right? And I think that's where we have to, in some way, rely on the discretion, or have to, fortunately, be subjected to the IRS discretion in this case.
Of course. Um, right, I think that's all the questions that we had submitted. So I'd just like to thank you all for attending today. As I mentioned at the beginning of the session, it is recorded, and so we'll share a copy of the slides and the recording with you in the next day or so. We will be staying on for a few minutes just to answer any last questions. So feel free to drop off now, or if you do have any further questions, feel free to submit them within the Q&A box, or unmute yourself and raise them to Sue Howe and myself directly. Thank you very much,
I
everyone.
mean, our contact at the end, the last slide with our contact. All
Indeed.
right, thank you, everybody. We'll see you in the office maybe next week. Take care.
There's actually quite a question in the chat box as well. If we're not doing
Yeah,
imports
go
or
ahead.
exports, can we ascertain that we're not a high risk business from a missing trader fraud arrangement? I guess I can touch on this, and then you can add any additional points. Whilst you may not be the importer, in other words, company A, or you may not be the exporter, which in our scenario was company D, there will be a number of buffer companies which are between the missing trader and the exporter. And it's those companies in the middle, which may be yourself, that often get caught up in the missing trader fraud arrangement. So the risk is actually still with yourselves being the buffer people. For example, the importer, which is the company A, that's the missing trader. And this legislation will not really impact them because they are doing the fraud in the first place. So the fact that the IRS have implemented new legislation to combat it isn't necessarily going to deter them from carrying on these transactions. And the same with the exporter. The exporter is generally party to the arrangement, so also needs to so may also not be deterred by the legislation. It is actually the companies within the middle, the Singapore companies, which are buying and selling within Singapore, that are most at risk from the denial of the input tax claims. So it is something that you are going to need to be conscious of.
Yeah, and I think that would be right as long as you are dealing with goods that are part of a missing trader fraud arrangement. You will be investigated by the IRAS, and then that's been the approach so far. And I know you've added a comment that you're from real estate developer. You really find it very difficult to see how MTF arrangement affects the business that you deal with. Now, as I mentioned, right, in the UK, sorry, two things. Firstly, the missing trader fraud rules apply to services as well. So whether you're buying building materials or you're buying construction services from your subcontractors, you are still caught by the rules. And as I mentioned earlier on, in the UK, they've introduced or they've extended the scope of the customer accounting rules to the building and construction services. Now, obviously, if they do that, it's something that the IRS is aware of. I'm sure that's another area that they will probably be targeting as far as missing trader fraud arrangement is concerned. Now, one of the easiest way, the IRS actually, the law actually has examples of what a missing trader fraud. One of the ways this can happen is when the value of the supply to your company, right? Even though you're the developer, where some of the services or the construction materials that are sold to you or supplied to you are supplied or sold at an inflated value. And what happens is that the supplier disappears. Now that also brings you within the scope of missing trader fraud. Okay, so that's the way that's the way I would see it.
Yeah, maybe I can provide a bit of color in respect of the UK construction services, because I had a couple of cases during my time when I was in the UK at Grant Thornton, where what we had is the client was a real estate developer, and they were contracting with lots of subcontractors to provide the construction services. And what was happening on a number of occasions is that they would engage a new subcontractor. The subcontractor would provide the services. They would bill them for the services. Our client, the developer, would claim the input tax, but the subcon developer would not pay the output tax to IRAS. They would just disappear. They would dissolve the company, and then they would restart a new company under a different alias, a different name. So it's not quite the same type of fraud. It's still a missing trader, but as you say, it's not in respect of goods going around in a carousel. It's actually the service company that is fraudulent and just disappears. That's obviously slightly easier from a tax administrator's perspective to identify, because it's not got a whole supply chain going along where goods are being delivered and received. It is generally the service provider that is disappearing, having provided the services. And that's where, to combat it, they've implemented the domestic reverse charge rather than relying on a due diligence process, which is more ambiguous from the developer's perspective to interpret. um, would the developer have been at fault? It's a bit of a grey area. Strictly speaking, no, because it's the subcontractor's liability to account for and to pay the VAT in this case to HM Revenue Customs. However, obviously combat this, the reverse charge has been implemented to make it more simplistic from the developer's perspective. It's actually the developer that now self-accounts for the VAT on the services provided. So HMRC obviously didn't have the ability to deny the VAT claims for the developer. So they were having to swallow that VAT cost. And I think the sums got so big that they felt like they eventually had to do something about it to close that gap. And that's why they've implemented the reverse charge.
Yeah, but again, if you look at it, having said that, though, when you look at Singapore experience and the new Section 22A, I think it's broad enough to be able to deny the developer the input tax claim. So while the developer may not be at fault, when the subcon disappears, the new rules actually allows the IRAS, it's written so broadly that it will allow the IRS to deny the input tax claims to you on the basis that the subcon has disappeared, and the IRS is likely to use the new Section 22A to deny you the input tax claim, even though you may not be at fault. The concern we have is that the legislation says that whether or not there's a loss of public revenue, then there is a 10% surcharge as well on top of the input tax claim that is so denied. So I think that's where the issue is. So that's really our concern.
Yes, Singapore's effectively used a different approach to tackle that scenario to what they've implemented in the UK now.
Okay. Thanks, Emmanuel.
Thanks.
You have our contact, and I think I know where you're working. So give me a call sometime. Give us a call sometime. All right. Thank you, everybody. Really good to have you all.
Have a good afternoon, everyone.
Have a good afternoon.